It was a chaotic day of trading as we saw stocks tumble again, nearly 3% on most indices, and a lot of that was exasperated when we saw Chairman Jay Powell lower interest rates unexpectedly by 50 basis points. Market received that poorly, sent stocks lower. Of course, when interest rates go down, bonds go up. So we had some big movements in the fixed income markets here today as well. So we'll talk about all of that, see how it affects our posture. Then we'll get into our trade application example, where I found a stock that's actually up 17% over the last month. It's a strong dividend paying company with a yield close to 3.5%. And we're looking at selling a put at a very solid level of support. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 3rd, 2020. First off, if you're new, welcome aboard. Remember to go over to our YouTube area, click subscribe on our channel, then go down to the description area and sign up for our email distribution list. That way you can be entitled to receiving all the stocks in the S&P 500 that are giving you overbought and oversold cluster signals every single day. In addition to that, we're heavy users of Twitter. Feel free to follow me at my handle at Brandon Van Zee. And we appreciate those of you that click like and retweet on these Market Outlook related tweets. Lastly, we have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, with that, let's go ahead and jump into our charts. As you can see, I've got chart 6D pulled up here, and is often the case when we have a wild and chaotic day, I like to start with this particular chart because it gives us a sense of how wild and chaotic things are. This particular chart here will basically give you a nice visual as far as how extreme the price action was today. So this candle right here will represent today's price action, which is effectively showing us that when it's a red bar like this down below the zero line, it means it's a negative day. And once it passes this orange horizontal line here, it means that the market was down at least 2%. You can see we nearly got to this pink line yet again, which would be the 3% level. Now remember, last week was a historical week, a historically bad week, where we had 3 out of 4 sessions with a 3% sell-off. So we almost added to that count today, but we're saved by the bell. And of course I say that somewhat facetiously, but we were only down 2.81%. Obviously still a very, very ugly day. It gave back more than half of yesterday's gains, which was unfortunate. A lot of people got pretty excited about that rally that we saw to start the week yesterday, and this day kind of threw a big wet blanket on top of any idea of a easy V-shaped bottom. We're still figuring that out. As you can see what the candle looks like up here on the S&P 500. We gave back a lot of yesterday's gains, and we're still trying to carve out a bottom of sorts. So I have a feeling that a lot of bears are kind of going to be gunning for this candle over here to try to see if they can kind of shake the tree a little bit more, get some of those weak hands out of there. But obviously that could create an opportunity for those that are willing to think a little bit longer term as well. Of course, what muddies the waters to a degree here is what's happening with the coronavirus, as that is front and center every single day that we wake up, depending upon the headlines, especially here in the United States where these markets are trading. It seems like traders are kind of taking their cues from the headlines. And if the headlines are particularly bad, then there's obviously going to be some negative sentiment on Wall Street. Yesterday was kind of an interesting day, because we saw a lot of the consumer staples companies do quite well, as we've been seeing reports. Some of you might have noticed me tweeting about this on Twitter about, Costco is out of hand sanitizer or toilet paper or paper towels or whatever it is. And that kind of lit a fire under a lot of those consumer goods companies yesterday. Today, many of them gave it back. There was one company in the Dow that actually finished in the green, which was Coca-Cola. So perhaps a lot of people stocking up on bottled water and different things like that. But nonetheless, we'll keep our eye on some of those areas. Perhaps there's going to be an actual sales boost to some of those kind of dry goods that you can keep on your shelves for a long period of time. We might actually see a sales increase during this particular quarter as people are hoarding those. I know I've had a lot of Amazon packages delivered to my doorstep lately, and a lot of them are some of those consumer staple-oriented types of goods. So there is possibility that those types of companies might be able to withstand any sort of economic pressure that is to come with the continued coronavirus news that comes out day after day here. But obviously today was a very sour day for the market. And it kind of continues a string of very ugly sessions that we've had, with the exception of yesterday, of course. Let me also show you this while I'm over here. Let me show you the visualize area of the Market Watch tab. I'm showing the S&P 500 right now, which has approximately 500 stocks. I say approximately because remember there are a couple of companies that have multiple share classes. Anyway, as you can see here, we did have a 10 to 1 type of a day. In other words, what I mean by that is you can see there were 462 stocks that were down today in the S&P 500, and there were 43 that were up. So there were 10 times more decliners than gainers. Oftentimes that's kind of a capitulation type of a move, but the reality is we've seen that multiple times here within the last couple of weeks. So it doesn't make today any more special than what we might have seen on Thursday last week or Wednesday or what have you. So anyway, just be aware of it, that they're still trying to shake out some of those weak hands, and they're doing an awfully good job of it. It's been chaotic trading to say the least. All right, let's go ahead and get now on track with kind of our normal chart routine. I'm going to come over here to chart 4B so we can take a look at the foregrid of the major U.S. equity indices here. And as you can see, no surprise, we remain with a strongly bearish posture on all 4 of our charts. Remember, you can identify that very easily by looking at whatever the background color of the chart is on this particular chart 4B. That distinguishes whether you have a bullish posture or a bearish posture. And when you have a deep shade of pink like we do right now behind all 4 of the charts, it means that we have a strongly bearish posture, not just a bearish posture. Like over here on the NASDAQ, this time period right here where we had that light pink shading would have been considered weakly bearish. Now that we're in this darker shade here, you can see that we are strongly bearish. And that basically means that the green line, which is the intermediate line, which is kind of our default line that we would use in this video unless we tell you otherwise. It's kind of an intermediate trend trading view of how to think about the markets. When that green line is trending lower and crosses below the 50th percentile and is trending lower towards the 20th percentile, that would be considered strongly bearish. And then anything in the lower reversal zone is considered strongly bearish, regardless of whether the line is rising or falling. So it's kind of interesting to look at these 4 different charts here. All of them actually show the green line rising, right? Remember, you can read that in the label for today's reading. So for instance, right here on the S&P 500, it says rising. It says rising over here on the Dow Jones, and it says rising over here on the Russell 2000, and then rising as well over here on the NASDAQ composite. But because those green lines are in the low reversal zones on every single one of those charts, they remain with that bearish posture. But I point that out because yesterday was a very aggressive up day, and it kind of followed a fairly strong rally in the afternoon on Friday as well. And that did help give some productive type of activity to that green line itself. And now that the green line is pointed higher, if let's say for the last 3 days of this week, 2 of them are up days and only 1 of them is a down day, that might actually be enough to get that green line out of the lower reversal zone, and we might actually go back to a weekly bullish posture on that green line. The problem, of course, is that we will still have broken chart patterns all across the board, and that's why the posture would be considered weak versus strong, and you'd want to walk very carefully, or just gently, so to speak, or have smaller position sizes, or maybe take safer types of securities in your trades. You don't want to get overly aggressive because it's the weak bullish postures that can easily convert back to strongly bearish postures. So it is a process, but the good news is the process is trying to carve out a bottom right now. Whether it actually gets there or not is anybody's guess. Today certainly didn't help that cause, but with that big rally we saw Friday afternoon into Monday's close, that was aggressive enough where it can withstand a day like today and not throw away the possibility of potentially going back to a bullish posture somewhat relatively soon. So let's keep our eye on that. Of course, David and I will be here to kind of guide you from that perspective on these daily videos as well. One other thing I'll point out, the market sentiment line is falling. So that's your orange line. You can read that in the labels there as well. So the market sentiment line was falling in all of those cases as well. So we have a bearish longer term trend perspective there with the market sentiment. And then also be aware that we had an above average daily range today. Remember that these labels that are above the price action will be either blue or orange depending upon the range of the day. So as you can see here, the range of the S&P 500 today was 160 points. Traditionally, with the average true range, it's only 64 points. So, it destroyed that, well over double the typical range that we had been experiencing here. And again, like I mentioned in the intro, the kind of interesting aspect of this whole situation today was that the Fed came out and did a surprise rate cut. It wasn't a huge surprise because, there were a lot of people talking about it over the weekend, but what I mean by a surprise is it wasn't a regularly scheduled event where we were expecting the Fed to make a decision. They kind of did it ahead of time. And a lot of times when you're trying to surprise the market with a rate cut, your expected result of that move and that decision is to see stocks skyrocketing higher. And this was actually the exact opposite. Stock market was up this morning before Chairman Powell opened his mouth and let the world know that the 50 basis point cut was a done deal. So it actually soured the mood once they learned that, the Fed is truly concerned as well. This is not just a skittish stock market with futures traders that don't know what they're doing or something along those lines. It kind of jolted the market to a degree that the Feds are concerned enough about the economy with this coronavirus scare that they're willing to cut interest rates by 50 basis points. So that was not a great response, let's put it that way. Now, who knows, maybe people come to their senses and realize that that will actually inject a little bit of adrenaline to the economic system going forward. But I think most participants recognize that a rate cut is not going to resolve the coronavirus issue. It can kind of grease the wheels of capitalism, but it's not going to be able to get people out of their houses if they're concerned about being in a crowd where they can contract the coronavirus. So there's a lot of work to be done. But a lot of it does revolve around whether we can get a handle on the coronavirus. If that can be done sooner rather than later, then I'd have to believe that the economy is still on strong enough footing and unemployment rates are still low enough that there could actually be some very interesting values emerging from this historic plunge that we've been kind of going through here for the last week or so. So for those of you that are longer term oriented, remember not to stick your head in the sand. Remember to try to learn from this experience and then look for opportunities where perhaps they're throwing babies out with bathwater. Some companies probably deserve to be going lower. Other companies are just getting caught up in the hysteria. So if this health scare comes and goes really relatively quick, I think that we'll probably look back at 2020 and say, you know what, there were some really good opportunities available to us at that time if only we had the courage to act. All right, let's go ahead and take a look here at another chart setup now. And we'll take a look at the 3 green arrows chart setup. This will be chart 4D. And not a whole lot to report here because it's still the same story as it's been for the last several days, which is we have 3 red arrows across the board on all of these various charts here. So not ideal conditions to be a trend trader in. This is probably a little bit better condition to be a swing trader in. And I teach both of those classes here at Market Scholars. And the swing trading class has been somewhat blessed in its ability to short sell stocks and our ability to be very nimble and get in and out of markets quickly. So we've been able to withstand this storm fairly easily, and we'll get back at it again tomorrow in class if you want to participate in that, if you're a premium member, and see if we can get some other swing trading setups going. But without a doubt, trend trading has taken a little bit of a shot across the face there a little bit compared to where we were before. The momentum stocks had been doing quite well, and they're actually still holding up reasonably well in comparison to the other factors out there. It's just that when you have a long-only portfolio and you're pretty fully invested, your trend trading account is going to suffer some significant damage when you have a week like we just experienced last week. So without a doubt, this is a little bit of a dicier time to be thinking about trend trading, but swing trading does seem like there's plenty of opportunity out there. So I'll look forward to seeing many of you in my swing trading class tomorrow at 11 a.m. Eastern Time. And by the way, we had a little bit of technical difficulty with our dividend growth investing class today, if any of you were attending that live. The recording is posted, so you're welcome to go check out the recording on our calendar, where we were able to look at the materials sector today to try to find an opportunity from the long-term perspective to put our long-term dividend growth investing money to work. So feel free to check that out if you're a premium member. All right, let's go ahead and take a look now at some of our 12 grid analysis, starting with chart 5A. Now, if there was a big time story today, it was actually the bond market. It was not so much the stock market. And here's the reason why. This chart in the lower right-hand corner of this 12 grid 5A. And let me right-click on that and maximize the cell so we can see it here nice and large. This is the TNX. And it has been remarkable to watch interest rates plunging here recently. Now remember, this particular interest rate is not directly controlled by the Fed. They can do things like announce short-term rate decreases like they did today, but they generally can't control the long end, at least directly. So be aware that this is market participants that are pushing rates around and pushing bonds up and down as well. So the big story here today was this candle right here. And at one point, some of you that follow me on Twitter probably saw me tweet about this as soon as it happened. The 10-year Treasury went below 1% for the first time in history. That's the first time ever that the United States has seen its 10-year Treasury bond yield at less than 1%. Remember, on this chart, if you're going to pull up TNX, you got to move that decimal point over 1. So you can see that it ended today just barely above 1%. So it ended at 1.01%. But on an intraday basis, it got down well below a 0.99% or 99 basis points. And that has never happened before. And you can see that was a very exaggerated candle that you see right there. So it was a big, big day in the bond markets. And you can see here that this particular instrument, the yields themselves down 40% over that time period. If I were to show you let me scroll through these, TLT now, notice that TLT is up about 11% over the last 3 months. Now remember, bonds work opposite or inversely to yield. So when you see yields plunge like I showed you a moment ago, it typically means that most types of bonds are going higher. And that was certainly the case with TLT. In fact, you can see that that candle with TLT, which tracks the long bond, so you're usually looking at 20 or 30-year bonds there. It's not exact match to the TNX, which is usually the 10-year, but nonetheless can give us a general idea of things. You can see here TLT had a very exaggerated candle today as well, along strong upper shadow, so perhaps that will be a little bit of a end to that surge, at least in the short term, but without a doubt, a very aggressive day as you saw TLT hit a new all-time high up here at about 156. And you look at that chart, and you're thinking to yourself, that looks like a growth stock. And then you have to kind of pinch yourself and remind yourself that that's actually the long bond. So for those of you that have a bit more asset allocation diversification out there, congratulations. Your bonds are doing well. And you hear a lot of people grumble about their 401k plan offerings and how they don't have a whole lot of choices to make as an investor, and they've just got some basic index funds in there. Well, the good news is many of you probably have some bond exposure in your 401ks, and at least that portion of your net worth has actually improved recently, at least according to this chart. So we've got to do our best to look at the bright side, and I suppose this is one of the bright sides out there. But it is certainly a harrowing time, and there's a lot of chaos out there in the financial markets. You can see that these top three charts now, as we go back to the 12 grid, are all dark pink, telling us that we have strongly bearish postures in the stock market in the United States, in the developed foreign stock markets, and in the emerging foreign stock market. So there's not really any great place to hide from a stock perspective wherever you're looking across this great planet of ours. It is ugly across the board. There are some other areas, including gold, that have firmed up. And you guys will recall that it was a couple of weeks ago we did a bull put spread on gold in this very presentation. And in the weeks prior to that, I had been putting on some bearish trades, like some bear call spreads on Facebook and NextEra Energy. So we were kind of gearing up to a degree. Now, I'll be the first to tell you that I did not assume that the plunge that we saw last week was going to, unfold the way that it did. But without a doubt, we were doing bearish trades in this presentation in early February in anticipation of that. And remember that gold is one of those instruments where sometimes you can buy it. So if you feel uncomfortable shorting stocks to get bearish, another thought that sometimes works, not always, but sometimes works, is if you think the stock market is going to go down, gold bullion can sometimes go up as it's kind of perceived as a safety asset. Again, you got to be careful with that because it doesn't always happen, but just pointing that out there as another reason why you might have been willing to get a little bit more bullish on gold here in recent weeks and months. You can see that that's actually a very productive chart that you're looking at there. And today was a beautiful candle. It bounced 3% off of that rising moving average there today, and continues to have that bullish posture there. And a lot of gold mining stocks went up as a result of that burst higher in GLD there as well. So that was probably the nice strong commodity out there for those of you that are looking for something outside of the stock markets where there is so much selling that's taking place here more recently. The dollar was down a bit today as well. The dollar's actually been unwinding here pretty quickly in the last couple of weeks. And remember, that can sometimes add to the appeal of gold as well. A weaker dollar generally brings a friendlier environment to gold, which is priced in US dollars. You can see that oil was down a touch today, however, and remains in a fairly ugly downtrend. So not a whole lot of safety in the oil commodity like there is in the gold commodity. Let's go ahead and take a look at another set of 12 grids here. Let's go to the U.S. sectors, where all 11 sectors were lower here today. You can see we've got a couple of green charts on the board, and that is technology and staples. But remember, the background colors are telling us what our posture is using that intermediate line on the market forecast. It's not necessarily telling us what's up today or down today. So both of those, technology was down 3.8% today, and staples was down 1.36% today. So all 11 sectors were down today to various degrees. Like always, there's some that are doing a little bit better than others. Today, the quote unquote winner, if you could call it that, was real estate. It was only down 0.08%, so call it break even there. And it was actually up for a good chunk of the day. So real estate did a really nice job of retaining value and preserving capital to a degree today, even better than its counterpart here to the left of it with utilities. But there were some really ugly candles out there today as well, including communications really struggling. It was down 3.29%, and financials, oh my goodness. Some of those financials are just looking horrendous right now. They were down 3.76% on the whole today if you're looking at XLF as your bogey. And I don't care what kind of a bank you are, you were seeing significant pressure today. Even kind of the pristine banks, or at least the perceived pristine banks out there like JP Morgan, were getting whacked pretty hard here today. So anyway, difficult day for the banks and some of those brokers and insurance companies and other financial related companies. And remember, usually it's those types of companies that struggle if interest rates go lower, because many of them earn what's known as net interest margin. And if interest rates are going lower, it means that the margin between what they're taking money in at and paying a deposit rate on versus what they're loaning money out and the rates that they're charging there, that's getting pinched, and therefore their profits are likely to get pinched going forward as a result. So anyway, many of those bankers don't like to see falling interest rates, and so this last week and a half must have felt like a nightmare to some of them, because as I mentioned before, interest rates effectively at all-time lows here in the United States. So the banks are having a hard time navigating that particular environment, and it's showing up through the stock market itself, with XLF down almost 4% in one single day. So you can see how ugly that looks on the chart there. In XLF's case, it actually gave back more than half of yesterday's gain, whereas that was not the case with other sectors that are out there. So that's one that finds itself on the way out in terms of sentiment. One of them that's improving in terms of sentiment would be the consumer staples. And like I mentioned earlier, some of that is a result of this hysteria and hoarding of, toilet paper and, supplies like that, where, stocks like Kimberly-Clark and Procter & Gamble and Coca-Cola and Colgate and Clorox and all those types of companies doing reasonably well given the chaos in so many other areas of the market. All right, let's do one more 12 grid, and let's make it a little bit different this time. We rarely look at this one, but since today was such an interesting day, let's go over here to the fixed income 12 grid. And you can see here that if you're involved in the bond market, you've had fairly bright prospects, or you've had fairly bright results in recent weeks. There's a couple of exceptions to that. Of course, you're seeing the two pink charts at the bottom. That's your convertible bonds that oftentimes will trade more similar to the stock market, because it's basically bonds that can eventually be converted into stock. So you're going to find that the convertible bond market will tend to emulate the stock market a bit more than other types of bonds that are out there. And then floating rate bonds are going to be a little bit different than fixed income that represents most of the other charts, because they're basically tracking interest rates up and down. The rates themselves are floating. So other than those kind of two oddball charts there, you are seeing that most of the other fixed income instruments that you see on the board in front of you have those bright green background colors, and things look pretty strong out there, whether you're looking at the aggregate U.S. bond market with BND or the corporate bond market with LQD. HYG doesn't look great, so I'm not going to really throw that in the category of your, pop in the champagne or anything like that. But at least it has a light green background there, so it's caught a little bit of a bid here recently. But foreign bonds look pretty strong. You can see that short-term treasuries, holy mackerel, I just noticed this for the first time right now. SHY just took off like a rocket ship. We actually talked about this one in one of my Q&A sessions here a few weeks ago as a place where you could kind of park cash that you weren't using. You don't see moves like that very often in SHY. That is remarkable. Medium terms treasuries, IEF is off to the races. TLT, I mentioned that one before. TIPS are taking off like a rocket ship here as well. And then muni bonds and mortgage-backed securities also looking strong. So if you're looking for strong bullish trends out there, it's possible you might need to step away from the stock market and look at the bond market instead, because it does appear that that's where some of those movements are taking place, albeit what I would consider to be quite extreme movement. So how long that trend lasts is anybody's guess, but the trends are certainly in shape right there. All right, let's go ahead and get into our trade application example. And for that, I wanted to pull up chart. Let's just do 4A here. And I'm going to pull up ticker symbol GILD. Now, this is Gilead Sciences. And as I mentioned in the intro, it's a fairly unique situation because this is a stock that's actually up in the last 1 month. You can see right here, it's up 17% in the last month. I'm sure as you kind of browse through your own portfolio, you're probably not going to see a whole lot of stocks that are up 17% in the last month, given the chaos that we've been going through. Now, Gilead is directly related to the coronavirus news, as they are kind of in a testing environment right now with one of their prior drugs to see if it's going to possibly work on the coronavirus. It's one of the drugs that they had developed during the Ebola scare. And there's actually human trials taking place, I believe, over in China with it right now, and also something taking place in Nebraska here in the United States. So it is kind of front and center in the eye of the storm there with the coronavirus news. Now, it's kind of all over the place. You can see some days it goes up tremendously, and then there's some days where it goes down tremendously. So this is not going to be for the faint of heart. But you can see that with today's move, you actually now have a bullish posture once again on Gilead Sciences with that green background color. And you can see we're rising off of that moving average that's also rising at this particular moment in time. Another thing that I thought was interesting about this is if you were to look back at a 1-year chart, you will notice that this stock had effectively been a sideways trending stock for the last year up until just this last month when it's been involved in the coronavirus news. And so this is a stock that was basing for an entire year stuck in a range. And it took, some sort of an exogenous event like this to kind of break it out of its range. But along the way, when it was trading within that range, it continued to pay very healthy dividends. One of the charts that I use in my dividend growth investing class is chart 2A. This is our dividend stair-step chart. And if you were to take a look at Gilead, you can see here that it is trading below this blue line. So in other words, it would be viewed as having historically attractive dividend yields even today, right? With the stock going up from $63 to $74, interest rate dividend yields have gone down. But this stock had done nothing for so long that it had produced a very strong kind of starting yield during that basing period. So despite stock prices going up, it continues to have a very attractive yield at this moment in time of 3.67%. So well above the average of the general stock market. And keep in mind, Gilead is not Johnson & Johnson, right? It's not an aristocrat. They've only been paying dividends since 2015. So take that for what it's worth, right? It's definitely a more controversial type of a stock pick. It's not exactly what I would call a blue chip company, but it is a very interesting example nonetheless. If I were to go back here and again show you chart 4A and pull up Gilead, and let's look at that 1-year view once again rather than 3 months. You can see that we've kind of established this bottom that repeatedly gets hit right here, off on the left, again right here, again right here, again right here, again right here, and again right here. And a lot of those bottoms are right around 62.50. So one of the ideas is the idea of selling a put in an environment like we find ourselves in right now where volatility is high. Remember, volatility spiked here today again. It was up 10% today, so the VIX finds itself at about 37 right now. So remember, when volatility goes up, the options contracts become more expensive. Now, if you're buying options contracts, buying something that's more expensive can be, a dicey situation. That's not what we'd be doing here with Gilead. We'd be selling options contracts. So we would be selling something expensive that's in a breakout chart type of a situation right now that has a very strong support level where the stock has bounced from at least 5 different times in the past year. So I find it to be a pretty interesting candidate from that perspective. Let's go on over here to the trade tab. And the contract that I'm going to sell is the April monthly contract with 45 days left until expiration. And you can see I've chosen the 62.50 put, which is going for somewhere around, let's call it 85 to 90 cents. The last trade today was actually $1.15, but this one doesn't get as much volume out there. You can see the volume on it today was only 55 contracts. However, you can see that the open interest is massive, 14,000 contracts there. So there's definitely traders in here dabbling with this particular contract, and probably for good reason. What I just showed you a moment ago, all those substantial support bounces. So let's go ahead and see if we can get filled on selling a Gilead put first thing in the morning. I'm going to go ahead and click on confirm and send. And remember, we're going to be taking in $76 here. And what it puts us on the hook for is our willingness to buy Gilead Sciences at $62.50 if it's trading below that level come April expiration. If it continues to trade above that level, which it's $12 above it right now, we then just simply get to keep that money. So it's kind of like thinking about placing a buy order but getting paid to do it. It's not exactly like that, so you got to be careful, but it has at least one way to conceptualize this trading strategy here. So we're going to take in $76 that somebody's going to give us for our willingness to say, yes, if it does fall down to $62.50 in the next 45 days, we'll be willing to purchase 100 shares. So let's go ahead and send that in and see if we can get filled. All right, thanks for joining me. Wow, what another crazy and chaotic day that we experienced. In particular, the bond market was plunging to, at least the yields were plunging to historical lows, and bonds themselves were rising to all-time highs in prices. So really dramatic day. A lot of it was, again, as a result of what we heard with a 50 basis point surprise rate cut by Chairman Jay Powell. So we'll see what this brings for us tomorrow. But as I showed you there with Gilead Sciences, perhaps there's some opportunities out there for those of you that are looking to kind of go counter to the market and look for bullish opportunities when so many other people are struggling with bearishness around them. So I want to thank you for tuning in. If you got value out of this video tonight, be sure to go over to Twitter and click like for me, and David will be back with you tomorrow. Have a great night, everybody. Bye-bye.